much news flow. It's so difficult to make sense of all of it. You've got second quarter or third quarter GDP numbers out of China. You've got austerity measures in Europe, and then you also have a lot of talk about quantitative easing. And all of this, of course, has to be used to make investment decisions. What does one do right now?
That's, I think, the million-dollar question, isn't it? Yes, there's a lot of information, but there always is a lot of information. I think for a South African investor, for any investor, in fact, you look for value. And there is no doubt the value is in the international markets. The big companies in dollar, sterling and euro. And these companies, they operate all over the world. You know, the pharmaceutical companies, the energy companies, even the companies like British American Tobacco, the cigarette companies. They're accessing the markets of the emerging markets, those enormous populations of India and China. But they're also operating in well-governed, well-regulated economies, being Britain, Europe and America, and they're on very high dividend yields. So we think there's the value. And one looks at currencies. For a South African, the rand is an important
So good time to invest offshore with a very strong currency.
Yeah, it's been a long road offshore. People who invested 10 years ago offshore haven't done very well. However, 10 years ago, those companies that we're describing were on dividend yields of 1%, not much more than that. They were expensive. Most of their earnings growth over the last 10 years has translated into higher dividend yields rather than capital appreciation. So now you're buying good value. And when buying value, it might still be a wait of a few years because these economies are all in quite deep recession now. However, one does invest for the longer term, and that's where the value lies. The value isn't in South African equities today.
Well, Simon, that seems to be a recurring theme that comes up in the studio. So first of all, the South African equities might be looking a little bit expensive, but also you should be searching for that dividend yield because it really is uncertain what company growth is going to, or what growth in equity prices is going to look like going into the next year, isn't it?
Absolutely, Stephen. Growth is subdued. Growth in dividends, it's, profit growth, because the economies are subdued across the world. And at least if one's getting a high dividend yield, you're getting a return in the form of that yield to start with. In time, as the economies improve and as the recessions, as we start moving out of recession, I think then you'll see the growth in earnings or the growth in profits coming through. And that is valuable. That's your driver for capital growth.
We said something quite interesting. You said those investors who invested in the developed world around 10 years ago haven't done very well. Who's to say that we are going to start seeing increases, of the developed market equities? I mean, look at the Dow Jones. It hasn't done very much in the last 10 years. And we know that the JSE has increased significantly. So it's obviously a very big risk factor at play here as well.
Of course it is. And the history of the last 10 years doesn't make one feel very comfortable about the next 10. However, it is very different now to the extent that dividend yields 10 years ago were 1% and today they're 4, 5,
so you have to run
even
after
6%.
that yield, the dividend yield.
So it's the dividend yield that is the key. The growth in earnings over time will really move in line with the economies, recession and growth. And at the moment we're in recession, so don't anticipate a lot of growth in earnings. But it'll come as we come out of the recessions.
Well, Simon, it seems that foreign investors are the ones who are pushing up our equity prices, also our bonds at this stage. Why are they finding value in our market when we can't find it there?
I wonder if they are. It seems that there's a big picture story relating to the currencies and relating to recession. And it looks as though the first world, America, Britain, Europe particularly, they see the way out of this through exporting. And to export your way out of recession, you need a cheaper currency relative to your competitors out there. And in doing so, it seems as though all these foreign inflows into South Africa and certainly all the other emerging markets has resulted in expensive currencies, which makes them less competitive from an export point of view. And probably another real driver is the fact that the interest rates, bond yields are higher in the emerging markets, so that foreign money is also coming in for those yields.
They're chasing yield. Do you think that they're also chasing the growth scenarios in these countries, or is it just a yield play here for these foreigners?
Hard to tell. Growth in emerging markets has been a lot better than the first world, and that may well continue for the sheer size of the populations and the fact that they're populations that now have spending power, whereas they previously didn't. So yes, the emerging markets are very, very important for future investment. We just feel access them through the first world companies that are well regulated, well governed.
So Unilever's, Johnson & Johnson's, companies like that.
And you'll find as the emerging markets, the Chinas, Indias of this world, which makes up 40% of the global population, as they become more affluent, which they are, they will seek well-known brands. You know, everyone wants the Levi's and the Sonys and the cornflakes, etc., the Kellogg's. So often the companies with the big brands, they do well. And it's interesting, those companies set up infrastructure in those countries in order to get the cheap labor and the production benefits, but now they have the infrastructure and can distribute into those emerging markets.
Simon, outside of the equity space, where would you be placing new clients' money at this time? Because of course we know that bonds are also looking a little bit expensive at these levels, and we don't know if interest rates could be cut again, which of course takes away the yield for money going into savings accounts.
Yeah. Bond yields, property yields are low, certainly in South Africa. So one would tend to avoid both fixed interest bonds and even property. You know, property tends to lag in a recession, and the earnings growth from property is not looking great going forward. It depends on the client, but a lot of clients are looking for high income, and you're not getting that from money in the bank. And the things to look at, interesting preference shares are giving you a little bit more income, and there is the potential for capital gain because of the gap between interest rates and preference share yields. Preference share yields are higher, and it does tend to be tax-free income for most. A thing to look at is inflation-linked bonds. Inflation is undoubtedly going to start creeping back into our economy, particularly if the rand weakens, and that will certainly give you an income stream that will be hedged against inflation, which is useful.
Simon, it's interesting, you've mentioned the word recession a few times in this conversation, as if we are still in recession. Could you elaborate your thoughts on the macroeconomy? I mean, it's quite interesting. It sounds, you're almost pessimistic about various things here in South Africa and on a global level, purely because you've spoken about it.
Lani, yeah, technically maybe we're not in recession, but if you just look at the plight of the average South African out there, and for many it's not good. 1 million people have lost their jobs in the last year. We have more debt today per individual South African than ever before in history, and some 16, 17 million South Africans have too much debt. There isn't the ability to borrow from the banks. The bank credit extension is as low as it's ever been. And all those factors means that the consumer is struggling and doesn't have disposable income. And these are recessionary factors. You're seeing the corporates out there not growing their earnings at any great rate. Pick n Pay's just cut their dividend, first time in years, probably 30 years that we've seen. It is an interim dividend. But these are all indications that things are tight in our economy.